At one point during lunch, Peter turned to me and said, just cheap doesn't work. And I'm like, what? What did
Mm.
you just say? Like he just basically took a hammer to my whole it's treasure chest of beliefs there. Buffett gives away all his secrets. How many Buffetts are there? People with Buffett-like returns. I mean, not to get into this tangent, but there are plenty of people claiming to try to clone Buffett. No one has succeeded so far as I know. The trick is in implementation. Just think of you have a good company that's a division and it's earning $2 a share, and a bad company losing $1 a share. A combined company is making $1 a share, and the market is like, let's put a multiple on that, let's say 15 times. The whole thing trades at 15 times, even though, you know, you could shut down the money losing business and have $2 of earnings, and the stock would re-rate fairly quickly.
You're watching Excess Returns, the channel that makes complex investing ideas simple enough to actually use, where better questions lead to better portfolios. Our guest today, Gary Mishuris, CFA, Managing Partner, Chief Investment Officer of Silver Ring Value Partners. He's an MIT-trained investor known for combining rigorous intrinsic value analysis with behavioral finance insights, and his North Star is always compound capital over the long term. He teaches the value investing seminar at Babson's College, FW Olin Graduate School of Business. He writes Behavioral Value Investor on Substack, where he explores this intersection of classical value and cutting-edge AI-enhanced research. And this is all part of why I wanted to get this guy, who's come all the way from the Soviet Union originally to leading a disciplined investment firm. And the takes, he's got takes, not the least of which this Warner Brothers one that we're going to dig in today. So long time coming, Gary Mishuris, welcome to Excess Returns.
Well, thank you so much for having me. Really looking forward to our conversation.
Well, us too. I brought Bogomil with me. We're going to tag team this effort. And again, you wrote this beautiful series of notes on the Warner Brothers merger. We're going to get up to that stuff. But I want to start here. I want to start with your learning at Fidelity in the Peter Lynch era. You were there in what, 2001? This shaped you.
Right.
Can you just, you had a rare experience in history. Can we start with that real quick? What was it like at Fidelity in 2001?
Yeah, oh, absolutely. I mean, so I just graduated from MIT, kind of when I started my investing journey when Buffett came and spoke on campus at the Sloan School, right during the tech bubble. And then for some reason, I have no idea why, Fidelity hired me. There were like 3,000 resumes and there were 7 associates that year. And I was sure when the director of research called that it was a mistake. And I actually almost turned them down because I was so, my father passed away at a young age. I was, my mother's only child, so I had my heart set on coming back to New York. So I'm like, I'll interview with Fidelity. It's like the home of old-time great investors, but I'm probably not going to really take it even if I get it. But he persuaded me. He said, hey, listen, we'll pay you. You can fly, visit your mom as much as you want. So I said yes. And I started, and it was an incredible time because this was a time when, if you think about the heyday of Fidelity, it was probably when Peter Lynch and Bruce Johnston were the 2 pillars, right? One on the kind of a more on the growth side, the other more on the value side. So those days were kind of behind us at that point. Peter was still a vice chairman. He was a mentor. I had the privilege of, meeting him a couple of times and talking with him. But by and large, it was the next generation of investors. And just as I joined, the market, bubbles started to pop and stocks started to collapse. It was definitely a very interesting time.
What a time. And I ask my guests on Talking Billions about those early days, especially when they started investing, because I think that shapes us. I'll mention about Peter Lynch, and you both know that. The reason why I'm here talking to you guys about investing today is Peter Lynch. I picked up his book, One Up on Wall Street, when I was a kid. My studies in Brussels, and that book, One Up on Wall Street, completely changed my life. So for you to work in his shadow, see him, talk to him, I mean, I would have been blown away at 20 if you told me that's even possible.
No, it's completely incredible. So we, as young associates, were given the privilege of like a small group lunch with Peter. And I read both books. So Beating the Street, One Up on Wall Street. I read them core to core in preparation for that lunch because, you're going to have this chance to like meet a living legend and ask him questions, right? So you can't blow it, and so, it was incredible just because, the guy was just so incisive and he would just cut to the chase so quickly. And I remember, he really hurt my feelings a little bit, not on a personal level, but I kind of was a very much of a classical value investor back then, Benjamin Graham, that kind of stuff. And, you know, I forget what my question was, but at one point during lunch, Peter turned to me and said, just cheap doesn't work. And I'm like, what? What did you
Mm.
just say? Like he just basically like, took a hammer to my whole like, it's treasure chest of beliefs there, right? And I kind of immediately kind of bristled and I was like, wait, but Joel Tillinghast, who kind of was one of the hires that Peter brought on, was someone I have considered a mentor my entire 25-year career. I said, but Joel does it. It works for him. He's like, yeah, I guess with the way Joel does it, it works. But just remember, just cheap, like low price to book something like that just doesn't work. And again, took me many years to really internalize that lesson, but like little nuggets like that, they were priceless. Or even, Will Danoff, who was one of the portfolio assistants on Magellan under Peter Lynch, and who was Joel. I would consider Joel at the time was there, and Will were the two kind of master, like legendary investors there. And Will Danoff, who runs the Contra Fund, is an amazing growth investor. He would ask these crazy questions. So he would come to meetings, for instance. Like we were all allowed to come to company meetings. His hair would be all messed up. You'd have the stack of papers, walk in 10 minutes late. Like if you didn't know who he was, you'd be like, hey, did this guy just walk off the street? What's going on? Who is this guy? Right. And then he would like interrupt. He's like, wait, guys, what do you guys do again? And it's like, oh no, and the analyst has like 25 questions, perfectly structured with sub bullet points. He's like, what do you guys do again? And he's like, and the CEO, of course, would answer Will's question because he managed a lot of money, was very, had a very strong reputation. And the guy said, well, yeah, but the last guy I talked to, he said he also did this. And the CEO would be like, well, this is a little awkward, but that CEO passed away. Yeah, but he said, like so you have these stupid static conversations, but they were not stupid at all. I mean,
Mhm.
Will was just as skilled as Peter was at like getting to the heart. What do you do? How do you make money? What makes you a good business? What's changing for the better? What's changing for the worse? So anyway, we can talk for hours, and I don't want to, have a runaway train here, but it certainly was an amazing experience.
We'll come back to the questions down the road. What kind of questions make a difference? I want to ask you about the certain story that you shared with me. And maybe this audience knows, maybe they don't, but I think they should. Silver Ring, the name of the company.
Yeah.
It has a story behind. And if you tell the story, I think we'll learn more about your journey to the US and also the appreciation of what has value, what has price in life.
Yeah, no, absolutely. And when I teach my seminar, I always tell my students when you assess an investor and you try to learn from them, you want to understand the context, like their life story, like how did they become who they are. So for me, so my family is Jewish. We left the former Soviet Union. I think it was in '89, and back then you couldn't just go straight to the United States. You had to go to a Western power. So we stayed 3 weeks in Austria and 5 months in Italy. And the Russians weren't very friendly to us. Like they said, okay, you're limited to $125 per person of cash you can take. Yeah, which is not a whole lot. And then they said, well, we don't want you to take your money and buy up a bunch of jewelry, a bunch of watches, what have you. So you're limited to one item per person, like one ring, one watch, whatnot. So when I was a little kid, my mom gave me a little gold ring, like that used to be hers in childhood. But we couldn't take it because it was my mother, my grandmother, and I, and it was the three of us. So we were going to take the three more valuable rings. That's all we could bring, right? And so here we are in Italy. And the way, immigrants made money, there was a bazaar, a marketplace, and you sold off your belongings. There were like charity organizations that helped you along the way, but you needed more money. So you would sell things off, right? And I specialized in these, commemorative matches where the Italians loved the Russian stickers with the wooden matches. And, that was I cornered that market. I made my first, seed capital of $35 at the tender age of 10. Um, but then, I made all that money and kept walking past this jewelry store and I saw this gold ring, and I'm like, wow, it looks like just like the ring I had to leave behind because we couldn't take it that my mom gave me. And so I got my mom's permission. She wasn't thrilled because, so it was 5 mil, at the time. So this is before the euro. So a mil is 1,000 lire, which was roughly equivalent of a mil was like 70 cents back then. So this was like $3.50. I'm a kid. I don't know what things cost, right? So I see this gold ring. It's 5 mil. All the other gold rings are like 40 mil, 50 mil, 100 mil, but this ring is like, well, like it's a little smaller. So I'm coming up with a story, with this narrative for why it's such a great deal. And I can restore my kind of, the equivalent of my heirloom, buy this ring. And of course, I find out very quickly why it's so cheap because, over the next couple of weeks, the gold wears off. And, turns out it was a silver ring, just gold plated and not very well at that. Now, I don't think the store was like trying to defraud me. There was probably something in Italian that said gold plated. They just didn't speak much Italian. But that story really kind of had a few lessons for me. One is like cheapness, like kind of a surface cheapness is just not enough. It's not necessarily a marker of value. It's maybe a sign to investigate. It's not the conclusion. And then also just that you have to do your research. Like if something is, too good to be true, potentially, like it might just be just too good to be true. And you need to dig deeper and find out what's underneath that gold plating, if you will.
Phenomenal story. Every time I hear it, it gives me chills. And I'll just mention, and I know Matt has many more questions, but I grew up in Cold War Poland. We're close in age. So a lot of the stories that you share, I can relate to, but I don't want to take over this conversation. Anyways, this is a beautiful story that made me
Thank you.
Tear up when you shared it the first time.
It's a beautiful story. And I love these principles that are inside of you. Like, I love that you can reflect back on this. So I want to take you to the piece that's the real reason, quote unquote, that we're here today. And I have to say, reading this and following this in real time, this made me think of reading about the Yahoo deal, whatever, 10 years ago when they owned the piece of Alibaba still. And it was so rough. So you write this Substack article, Warner Brothers, how 5 mental models turned a hated stock into a 3x opportunity. And there's just not a lot of studies about stuff like this. So I want to start here. You open with, it felt lonely owning Warner Brothers. And I know you got the crap kicked out of you for a while with this thing. Take me back to that and let's talk about maintaining conviction. Like, how'd you do it, man?
Yeah, I think, well, I'll get to how you do it because it's not easy, but it's also I'll just start there. Why not? I think in general, you have to be wired not to be a contrarian, like consciously, like, hey, I'm going to be opposite of whatever everyone else is saying. You have to just be wired to think from first principles and have the temperament to ignore the crowd. But we'll come back to that. So I think, Warner Brothers, so I have a long history of the company. I made some money in an investment in the past. I've held it for a number of years. Then, this merger happened. For those of you who don't know, basically Discovery Communication bought Warner Brothers from AT&T. And this is like the assets they bought were storied assets, Warner Studios, HBO, the library, Harry Potter, all of the stuff, the HBO library. And the idea is they're going to merge together. They're going to get scale because John Malone, who was on the board, who's kind of the mentor behind the CEO of Discovery, David Zaslav, John Malone was a big believer in scale. He's talked about the media landscape and how Netflix has the scale, Disney maybe has the scale, nobody else has global scale, you needed to compete. So that was kind of his vision. He thought Discovery was subscale. Let's put these assets together, create a global competitor. Well, like this was like one of the, maybe not the worst merger in history, but it felt like the top 10. If you guys all remember AOL Time Warner, the original deal, kind of, the back slapping on stage, that quickly turned into the biggest write-off in history. This was kind of in the running for, top 10 in that regard because, they did the due diligence, and as soon as they came in, turned out like a couple of billion of profits they thought were there were not there. Things were worse. All these, it got so bad that at one of the annual meetings with Discovery, there was this woman gaslight, kind of like almost screaming at Zaslav, like, "Why you get paid so much? This is the worst. This is like a broken private equity deal." Like, and when you hear that level of revulsion, you got to believe that, there's not a lot of optimists out there. So then you kind of fast forward, a little bit. And what's happening here is, the problems, yes, the profits are lower than were thought, but the management team is fixing things. They're improving things here, improving things there. The streaming business, or at least I think of it as the distribution channel, which was money losing, is now money making. It's growing profitably. So things are better, but the revulsion is still there. I mean, I remember I talked to my former coworkers, and they were like, "Gary, you're insane. This is like a secularly declining business. Why are you involved? You don't need to be here." I talked to like a hedge fund specialist, acquaintance of mine who does media. He's like, "I won't touch this with a 10-foot, pole. There's so many, and I do distress all the time. This is just broken. It makes no sense. Yada yada yada." And the reality is, so one of the first business kind of mental model I talk about in the article is that you have the good company, bad company combination, right? And like the example I give is, just think of, you have a good company that's a division and it's earning $2 a share, and a bad company losing $1 a share. Combined company is making $1 a share, and the market is like, let's put a multiple on that, let's say 15 times. The whole thing traded 15 times, even though, you know, you could shut down the money losing business and have $2 of earnings, and the stock would re-rate fairly quickly. Now it has to happen, but the potential is there. Which leads me to another mental model, which is, okay, you have potential and kinetic energy, right? You have two balls, they're lying still, but one is on the floor, the other is on the edge of this desk. Their current state is the same, but the future possibilities are different. You just need a nudge, right? And then the nudge, kind of that activation energy, if you will, was the company decided to announce, hey, we're going to actually spin off the bad business, the bad, the bad, forgive the French, the shitco, as the market called it, literally. There was actually, I think, some major publication used that language, so hopefully I'm not too out of line. And we're going to spin this company off, and we're going to be left with the good assets, Warner Brothers, the library, HBO, streaming, and the cable networks. The business that's declining, going to trade separately, put a bunch of debt on it, hope it survives, kind of thing. So that confluence of events kind of made me think of Charlie Munger's point of Lollapalooza effect, which is his idea is when many multiple like mental models come together, you have disproportionate effect, right? You have, you don't have a 1.5x effect or 2x, you might have a 10x effect. You had a hated stock, you had a lot of, intrinsic value potential. So the stock was trading $7, $8 a share. My intrinsic value estimate was, in the low 20s on a standalone basis for the two pieces. And then you had this activation energy of a change coming that was going to unlock the value. So to me, it was a pretty good setup. And I try to be very rational with my position sizing. And I'm a concentrate investor just by virtue of the fact that I want quality and I want a low price relative to value. And those two things are pretty rare in combination. So I thought this was a quality business, at least certainly the good company was. And then the price was like slightly more than a third of intrinsic value, which was, it's shocking for a large, liquid company, right? This maybe in micro caps you get that. And on top of that, you had a event, which we'll talk about this in a second, made it perfect for something I use very, very rarely. And I want to get this out there because I don't want, if you're listening to this, I don't want you to come away thinking that, Gary's sitting there like day trading options or 0-day options or something like that. That couldn't be further from the truth. The vast, vast majority of what I do is long-term holdings and good businesses at an attractive price. Occasionally, though, a company can have long-dated options that are even more mispriced than equity. And we can get into that if you want. And in this case, that magnified the opportunity even further. So anyway, that was the setup. And I think, we can go in any direction you want from that.
We'll come back to the different bits and pieces of the investment case, which I find fascinating. And I hope the audience knows it's not a recommendation. It's a case study that we want to dive in and understand. But I really want to zoom in on the good business, bad business for a couple of reasons. I think one, if you have a mix like that, the screens don't pick it up. I think that the headline, what the business is about, miss it. So you really have to go deep and be very intimate, very familiar with the business to realize, wait, I'm buying two businesses. The market sees it at best as an average or maybe leans toward the worst part of the business and implies a much lower valuation. Tell me more about that. How did you know that? How did you see it? What made you think that it's two businesses? Can you talk more about that aspect of your research?
Yeah, I think, I'm not one of the, I don't want to be one of these guys who, is Captain Obvious and they claims to have amazing insight about something that's not that hard. So it wasn't hard to know that the businesses are pretty discrete. The company even broke them out separately. So it's not that I was Sherlock Holmes and found this footnote in a 10K that said there was a separate business. I think the issue was one of perception, right? You had a scenario where the thing from this rapidly declining business, and again, for context, cable networks, so Discovery Channel, TBS, TNT, CNN, what we're talking about is the bad business, used to be an excellent business, right? It's still not a terrible business. What changed though is that the growth profile went from above average to declining, right? So it's still a high return on capital, high margin business. It's just a declining business. And the market hates declining businesses. It doesn't know how to value them. It automatically assigns a low multiple to them, very low multiple, because in truth, declining businesses are hard. Like they're hard for investors, but they're hard for managements as well. Like if you think about managing a declining business, that is darn hard. It's much easier to create a good culture. Think of a growing retailer. Take an assistant, manager at one store, promote them to be the manager of a new store. Everything is growing. Everyone is happy. There are no layoffs. There's less politics. The pie is growing, so you don't have to have infighting and all that. That to like a shrinking business, it's much, much harder to manage, right? So basically, you have this taint where it's not that market didn't know that there were two separate businesses. It just didn't care. And it just said, listen, as long as I'm getting this bad co in the mix, I don't want it because I have no idea what's going to re-rate the stock. And all I'm seeing is, high single digit revenue declines that's translating into double digit profit declines in this, business, which is the majority of profits right now, but not the majority of value. And that's, I think, what the market got wrong. It was the majority of profits, but the majority of value. And then as we, if we fast forward to now, if you see from the bid, the bid, came in, the vast majority of value was in the good co, right? And I think that's what the market got wrong. It overly focused on the vivid negative and decline of the cable business and painted the whole picture with that negativity, if that makes sense.
So one of the parts of this that I'm fascinated by the way you thought through this was the obvious part, tangential to the good co, is the IP. Like that's the part that any of us can look at and go, of course, because we can all say, I wish I made or was responsible or somehow tied to any one of all of these different pieces of intellectual property that they possessed in this wrapper and this giant roll-up that was going on. But the brutal part was we can all look at that and say, I know that that's worth something, but the catalyst, like how did you understand the good assets, the good pieces of the IP, and then how do you even think about what the catalyst would be to eventually even unlock some recognition of the good co, as you were just explaining it?
Yeah. I mean, I think you're asking the right question. It's also there's two layers, and like the second layer to your question is a very sophisticated one. So I'll come back to that in a second. But I think there's two layers of value to the good co or the Warner Brother assets. One is simply what is there today. And it's a profitable business. It's growing. It has a large moat around it. And one good test, like if you ever want to have a quick mental check of how good a business is, just ask yourself, how much money and time would it take for someone else to replicate it? Or how much time and money would it take for someone else to make it a bad business? So this, if Microsoft or whoever the deep pocketed, company of the day is, wanted to make Warner Brothers a bad business, it couldn't for a long, long time. It would have to, create similar IP from scratch, lose a ton of money, on big production films and so forth. And it would just not be able to, it wouldn't be able to do it, So the moat is very clear. The profitability is very high. And I thought that those assets standalone were quite valuable. Now, this more sophisticated kind of implication, your question is, well, there's an extra potential for those assets in different hands, right? So you have if you listen to what, for instance, Netflix, who's the current, acquirer, we'll see how that shakes out. What they said on their call, they said, well, we love the assets. We don't want to change, fire people, but we think we have ideas how to make them even more valuable in our hand, right? Maybe distribution, maybe, additional creative activities, things like that. So as a platform so I always like to think of a value stack. There's what's there now, demonstrable value. No, then there's the growth of what's there. And then the third layer is what can be built on top of the current platform, right? And it's that last layer of value that could potentially be higher in the hands of someone like Netflix than maybe in the current management, right? But I want to make it clear that it's not just a bet that someone will come in and create new value. The value already in there was well above the market price at the time. I think that's, like Buffett, makes this very clear. Like you don't want to, if you need more than a full function calculator to figure out if something is undervalued, it's not. You need it to hit it over your head, kind of with a baseball bat, and you need to basically, when something is incredibly undervalued, you should question, wait, the numbers must be wrong. There's no way it's priced at this level, as opposed to, gee, is it attractive? If you ask them if it's attractive, but we're true in other parts of life, but won't get into that. Is it attractive? It's not attractive.
Gary, I want to ask you about options. And I'll make a
A
confession
dangerous
here.
topic, right? For a value investor, yeah.
Well, for the audience, really look at what you're buying when you start to play that game. I personally have not bought options in 20 years. I owned a few at some point of my career, a topic for a different episode, probably a couple of lessons there. Anyways, I find it easier, more doable to find a business that's undervalued than to tell you, me, myself, my clients when the price value gap will close. I honestly don't know. And I mean, only last week or two, I was trimming some positions that I've held for 12 years. So sometimes it takes a while, but when they do well, they can really surprise you on the upside, but I have no idea over the timing. So you used options in this case, massive mispricing. You talk about how pricing models usually work, and this was a hugely discounted stock in your mind, no pending catalyst, and you took a long-term view, but with an expiration date. And you and I think many value investors don't like expiration on an idea. Talk to me about it.
Yeah. So again, I think that if you never touch options in your life, you'll do just fine. Like, so I want to get that out there. And also, again, I know we're talking about it kind of in this case, but it's not all representative of the majority of my investment. Which brings me to another point. So when I teach my seminar, we start with security analysis, right? And I think Ben Graham in there defined investing in a very specific way. And I remember because I read the book 4 times and I teach it every year. So, he said an investment operation is one which upon thorough analysis promises both safety of principal and a satisfactory return. And again, not to dive in too deep, but the words are intentional. They're in a separate block paragraph. This was in the early 1930s, right after the 1929 crash. So he was very deliberate in defining things. It was not, the choice of words was carefully chosen. He said an investment operation. He did not say an investment. And what that means to me is that you really want to think about margin of safety at both the individual investment level and the portfolio level. But ultimately, it's at the portfolio level that margin of safety is the most meaningful, at the level of operation over time. Operation, he was referring to a partnership, like he was running like one, like I'm running. And basically, the idea is that, you don't have to have every single investment have no more than 5% downside or something like that, for the portfolio as a whole to be quite safe. So let me unpack that and to get into, options. So first of all, right, one of the mental model I have for portfolio construction, and and I'm not trying to gamify it, so I don't want to take a serious thing and make it into a game, but compare portfolio to, as we Americans call it, a soccer team, or the rest of the world calls a football team, right? You don't want to have, 11 goalies, or you don't want to have 11 strikers, at least not if you want to win at the competitive level.
Yeah.
You're going to have, some forwards, you're going to have some midfielders, you're going to have some defenders, and you're going to have a goalie. in some proportion, right? So I think a good portfolio also has elements where the vast majority of the team is not strikers, right? They're, somewhere further back in the game. Otherwise, if the strikers don't score, then, you get a lot of goals scored on you. So most of my portfolio is composed of good, safe businesses with high individual margin of safety. That in turn, I think, allows me to occasionally have small portions of the portfolio where the expected value is extremely attractive, but there is a risk of total loss. In this case, we're talking about the most this position ever was at cost was 5%, which by the way is huge for an option position. I've only done this once, in my, almost a decade. And again, the reason was the confluence of mental models. And again, not to get into the esoterics of options, but the options themselves are mispriced on top of the mispricing of the equity. And here's why. And the reason is, the market prices options using something called, as you know, the Black-Scholes, formula, right? And that basically assumes that stocks wiggle randomly around the mean, and that mean moves forward at the risk-free rate. That is pretty useful for like a 1 or 2, 3 month option. As you get into longer options, there's a mispricing because the longer term options, the intrinsic value of the business shouldn't be growing at 3-4%. It should be growing at 10% plus, or whatever your discount rate you're using for the market. So the longer the option, the bigger the mispricing. Now, if you add that to the fact that here you had an event. So what's the big negative of option? The big negative is expiration date, right? It sucks. Technical term. It sucks because you always, as an investor, would prefer to have time on your side. You want to be able to be wrong for a bit and for the business to solve its difficulties and not have the clock hold on you, right? Here you will have the clock hold on you. That is a huge negative, and which is why I say vast majority of the time you should not use options. However, you had an event, and that event was the company announced that they're gonna, in the first half of 2026, they're going to spin off the bad company. Is that a guarantee that the stock will re-rate? It's not. But does it significantly increase the probability now that the major reason for the mispricing will be removed, meaning that the pain of the declining business affecting the valuation of the good businesses? In my estimation, the probability of re-rating was much higher. And so the options I took were like 18 to 24 months for the most part, which I felt gave me plenty of time horizon for this event. Importantly, I was buying them at what I thought was about 10 cents on the dollar of intrinsic value. Intrinsic value being defined in this case, not in the language of options, but saying if my intrinsic value for the business is roughly right, and I take the payout of the option and discount to the present, that's kind of the value, the fundamental, if you will, value of the option. So I think you had this extreme mispricing plus an event which aligned to a large degree the time horizon of the option with the time horizon of the likely correction of the mispricing. So I would not recommend doing this, on a general stock because, in general, you have no idea if even if you see a big price to value gap, if that will change next month or in 3 years. But here you had this extra factor, which made it much more likely. And that's why I thought it was a very high expected value investment, even though the downside of that 5% was still 100%. It was possible that would expire worth.
There's another angle inside of this that I think you wrote about very eloquently, and I think it's really interesting. And it's in the inflection point, basically when the auction happens, because you shift from here's what it's intrinsically worth, the intrinsic value, to what's the most somebody's going to pay for this thing,
right?
And ego comes splashing around. I'm very curious about how you both thought through that in real time and how you look back on that part now.
Yeah. And by the way, that's anathema to value investors, right? Like we hate the idea that, it's like monotheism, right? Like there's like, you have to have only intrinsic value matters. Yes, there'll be noise in the short term, but in the long time, in the long term, price will approach intrinsic value. That is the foundational belief of almost every value investor I know. No matter whether they buy compounders or they buy distressed cheap stocks, they believe that. And obviously there's changes in the value and there's a lot more involved, right?
Mhm.
And then if you start to introduce other mental models, like I bristle at that. Like this is the first one I ever heard of was George Soros's theory of reflexivity. And it just as a quick detour, it goes something like this. Most of the time, price follows value, but other times, value follows price. For example, like 2008, 2009, bear stearns, right? There were, fears about bear stearns in the market. The stock price went lower. That created additional fears among the customers. The customers left, or some more customers left. The price went even lower. More customers got scared, and eventually Bear Stearns went on there, was bought by JP Morgan, right? So in this case, it was a reflexive spiral where the price was changing the value, right? Not the value changing the price. Now there are other models, in this case, the auction mental model. And, again, not to geek out on you completely, but, I'm sure you probably know like the idea of Nash equilibrium, right? Game theory, John Nash created this idea that, you have a payoff matrix and the game has a stable equilibrium. Well, some games have an equilibrium where this outcome happens and there's no reason to deviate. And that's the idea of intrinsic value. It's like it's meant to be a Nash equilibrium. Like you deviate temporarily, but eventually you approach it and you stay at intrinsic value because it's the correct number. And if you go too low or too high, different actions happen to correct that. Here, you have an unstable equilibrium. And I think the story I told so I went to this behavioral finance seminar at Harvard 20 odd years ago. And Professor Max Bazerman did this experiment where he sold a $20 bill to a room full of senior investment professionals. I was by far the most junior, for like $24, And I came up to him after the seminar. I said, "Listen, does this always work, or are we just a particularly stupid bunch of people that you encounter today?" And he said, "No, I've done this hundreds of times. It always works." And and then I was a speaker at an investment conference a couple of years ago, and inflation, 20 years have passed, so I decided to do $100 bill, and I sold this $100 bill, for $120. And I only stopped at 120 to like not embarrass the person too much. And the point is, it is possible to have a set of circumstances where you locked into a payoff matrix that looks like this. Pay a little bit more, and your payoff is positive, or stop bidding and your payoff is negative. And that's what causes the spiral. That's why people keep going. I won't get into the detail, the mechanics of the auction, but in this auction, right, once you have two serious bidders, it's not just about money to them. I mean, these are like alpha billionaires, and I'm not a billionaire, I don't know about you guys, but like I imagine, so I can only speak from like imagination.
Bogomil's
like,
Leap's position hasn't paid off yet, so it's
I'm still
wait and
sitting on
see.
it.
You're a future billionaire. You're a future billionaire.
future billionaire on paper.
Future billionaire.
I think
There you
all
go.
three of us are, but anyways.
But you have so much public reputation, ego invested that it's no longer about what is the intrinsic value. Paramount, Skydance, and the Ellison family on one hand, and Netflix to a lesser degree, but not sitting there saying, "Gee, let me take out my Excel spreadsheet, punch in the DCF, and say exactly what's the intrinsic value of this beast." By the way, the intrinsic value is always a range, right? We don't know exactly what the intrinsic value is. They're saying it's shiny. I already decided I want it, and I'm gonna get it. Again, I'm being facetious with my language, but like that's the level. And there are all kinds of tactics. You obviously don't want to overpay more than you have to. Maybe you threaten to walk away. There's a game, but it's very likely that things have shifted. Now, does that mean you go and just say, "Hey, it's time to gamble. I have this clever mental model, intrinsic value out the window. I'm just going to gamble that these guys will keep outbidding each other." I think that's very dangerous. Again, and that is like extremely speculative. But options, for all the negatives, which are huge, again, I'll keep emphasizing that options for the most time suck for long-term investors, at least buying options, call options, but they have the ability to keep restructuring risk, right? And so in my case, what I did when we entered this auction stage is I took the vast majority of the profits off, and I locked them in because and in the outcome that's played out, that hurt me. But I always teach my students, like, look, just because something didn't have the maximum payoff doesn't mean it was a bad decision. You have to consider many possible outcomes, and the auction could have aborted. There could have been the regulatory interference. There could have been, a market crash, and Oracle stock, which is a source of wealth for the Ellison family on the Paramount side, could have cratered, and who knows, right? So the way I structured it was I took the vast majority of the investment and locked it in. And then I left the tail position, but with a lot of what's called convexity. Convexity means in the short term, it doesn't go up much in response to price, but if price reaches a certain point, there's a hockey stick effect, right? And the theory behind leaving that last little bit was the auction model that, hey, people were talking about whether the bid will be 2019 or 23. I said, wait a second, there's a pretty good chance this could be 30 plus because you can easily get there in the numbers. My standalone intrinsic value was low 20s. If you apply a typical control premium for large companies of say around 40%, there's your $30 right there. And that it doesn't even get into any kind of irrational or seemingly irrational bidding. So the long story short is you don't want to gamble on things that are unforecastable, which is how far the auction will go. And certainly, but I think that you can change your risk profile where you're taking the vast majority of the risk and taking it off, and you're leaving a very high expected value, small amount. We were talking about a couple of percent at that point, but again, at a very convex payoff. Anyway, I told you much more minutiae than you probably wanted to hear, but that's kind of how I thought about it live at the time.
We did want to hear all about it. And I hope this audience is paying attention because I think it's pure gold what you just shared when it comes to investment philosophy, especially the last bit. Taking money off the table, especially when it feels like a gamble at that point, but leaving a small position so you still participate. I've seen so many times when a long-term position that I trim, it doubled again, it doubled again, and doubled again, and far exceeded anything I expected of it when I initially bought it. So I think there are two parts to it. There is time to take money off the table. Don't take all of it. Leave some, obviously case by case, but there are opportunities that can be much bigger, much better than,
Yeah, no, I think you made a very wise point, is that you have different classes of investment, and some classes of investment have a long right tail, and that could just be a compounder or a business where management keeps out executing expectations or keeps setting value in some new ways. Or it could just be something like this, right? Where there's just a long right tail of possibilities. And then you have very capped, finite businesses. All right, it's a cyclical. I think it earns $1 in mid-cycle. The stock is trading at $5 because people don't believe it, or they want to see the turn in the cycle before they invest. The stock reaches whatever fair multiple you think it is, whether it's 12 or 15, whatever it is. There is really not much rational right tail. Now, maybe it'll get overvalued because people overestimate the cycle. Fine, but there's no real reason for the right tail to exist. So I think what you're talking about and what we're talking about is very much applicable to businesses or investments with that long right tail. And I think the general point of this, like if you're listening to this, I would say is so important, is that it's not enough to have the right mental model. You have to apply it. You have to understand what circumstances does it apply under.
So speaking of mental models, when I was reading your essays on Warner, which by the way, I highly recommend for this audience to, after listening to this, go and read it in your own words, how you framed it. I saw two things that really hit me. One, this eternal need for us humans to be entertained.
Yes.
And on the other hand, an industry that has been entertaining us going for a massive transformation. A lot of it is around delivery, right? It's not a DVD. It's not as much the movie theater anymore. So the channel is changing, but also the production is changing, the distribution, the global distribution, the fact that you can have the same show, movie available to people in 100 countries overnight, which is unheard of. We're kind of accepting it, but really unheard of a decade or
Yeah.
two ago, right? The logistics. Talk to me about this eternal need to be entertained and this massive transformation in this industry. Like, how do we, it's like no change at all and a massive change at the same time.
Yeah, I mean, it's a fascinating space because if you think about, you know, like quality of business, right? One of the questions is how permanent is demand? Right? And you can like say, hey, girls, I know, teenage fashion apparel, demand can change in the women. What was in fashion, one year will be completely out of fashion the next, and you have a bunch of inventory that nobody ever wants, buy at any price. On the other side, that you have things that always will be in demand, right? Basic food, yeah. But and this, in a sense, is food for the mind or the soul, whatever you want. Like, so we always want to be entertained, and the inventory, in this case, movies and libraries of content and characters, intellectual property, never go stale. They might get under monetized or under created at some point, but if you have Captain America or whoever, you can always build, on top of that, or Harry Potter, or even them making a new Lord of the Rings, which again, sometimes I feel a little, like, it's like Godfather, 3 is probably plenty. You don't want Godfather 4 or something like that. But the point is, you have evergreen demand and you have evergreen inventory. Now you do have new distribution methods. And I think where the challenge is, and this is a longer conversation than probably we have time for, is you have ports which essentially hijack this bundle, right? And you have this bundle in America, at least in the US, less so in Europe and other places, which is very expensive because you have to subsidize the whatever 10-20% of the audience that watches sports. And you're not allowed contractually to have a truly skinny bundle of just what people want to watch, who don't care about sports, which is most people don't watch sports, or at least they wouldn't pay the money monthly to watch sports, that would be required to support it. So you have this very big bundle, which accelerates this, cord cutting or substitution away to various streaming services. And this is classic. If you read Clayton Christensen, The Innovator's Dilemma, Innovator's Solution, like Netflix is right there, which, the irony, I mean, I'm sure you know it. I don't know if probably many of you do, but for those of you who don't, Jeff Bewkes, who was the former CEO of Warner Brothers, once called Netflix the Albanian army. And it was in the context of saying, hey, look, they're not really a threat. It's like the Albanian army is going to take over the world. And I think Reed Hastings, the CEO of Netflix, actually used that internally to motivate the troops and say, hey, and he showed up, I think, with like Albanian army berets or something like that to his senior management team or something. The point is, this has occurred many, many times, like in steel, where you have rebars, the low end of the market, nobody cares, the big players let them come in, and then they move up and up and up. And Netflix came in just like that. It's an amazing case study, amazing management team. They came in and said, we're just gonna give you, the movie studios, extra revenue because we are going to send these these discs in the red envelope. Then we're gonna give you extra revenue for free. You can monetize extra by just we're gonna stream for like $8 a month, $9 a month. No big deal. It's not gonna cannibalize your revenue. And then little by little, they get bigger, they get bigger, they get bigger. Then they started doing originals. Then they started doing originals better than the incumbent players in many cases. And the short-sightedness of the industry allowed Netflix to get to a level where they're so powerful that they're impossible to unseat. There are other issues, like John Malone likes to point out. There's this regulatory unfairness where Netflix gets to free ride on the infrastructure of the cable companies and so forth. But regardless, you have this digital distribution, and you have this plethora of content now being created across the globe, locally as well as centrally. And I think the winners are the consumers, I think the losers in many cases are the legacy businesses that didn't adjust in time, unfortunately.
Well, speaking about adjustments, one thing that I really wanted to get into with you because, and I feel like Bogomil will share the same arc on this, is you went from not really using AI at all in your processes
Right.
to what, middle of 2025 being like, oh, yeah, I'm playing around a little bit. And then I think by November, I was seeing you write about the thousands of hours or some ridiculous quantity. And
Hundreds,
thinking,
hundreds. I don't want to oversell hundreds, yeah, but yes.
okay. I had a leap option out on that one. So
Yeah, if you lever it up, it's thousands, but no,
if you lever it up,
yeah,
it's thousands.
yeah.
I'm really curious about what happened and then what the process is taking shape now coming into 2026 here for you. What's the fascination with AI in the process?
Yeah, well, so first of all, I have no special advantage in AI. I have a computer science degree from MIT from 25 years ago, but that gives me, other than being able to think logically, it doesn't give me any special insight into anything. And like, if you're listening to this, I would encourage you, on AI, the major takeaway for you is go and start iterating on how you're going to incorporate it into your process. Don't wait for some final state or some perfect solution. Start using it systematically. And that's what I started, because I said, well, this is a tool. It has potential I don't fully understand, but it's positive. I don't think it's some kind of magic, like genie in the bottle where you say, AI, which stocks will go up next month, and then give you the stocks to buy. I mean, giving a ridiculous extreme example. But I think that, like, if you take the hype away, and there is a lot of hype, because there are a lot of people trying to charge you for this, create businesses on top of ChatGPT or Claude or Gemini, whatever, and basically put a wrapper on it and say, here's, pay us a lot of money. I decided to say there might be value in some of those businesses for sure, but let me just go from first principles to tools. Because I'm a very much of a process guy, right? Like, I pride myself on being systematic, process driven, how I approach investing, which lends itself then to adding AI in, because I'm not sitting there in an armchair saying, "Ooh, what's going to be the next 100 bagger?" Oh, okay, I got it. It's this guy. No, I have a idea generation process. I have an analysis process. I have a portfolio construction process. I have a risk management process, and so forth. So I start using AI, experimenting. I start experimenting with different prompts, with different LLMs. So comparing how my interns were helping me with that as well. And so what the result of all of this has been is I wrote this kind of white paper that's freely available. I encourage you to take a look, called the AI Equity Analyst, that I put up online. And it shows where I think right now, based on where we are at today, you can incorporate AI into your process. And the idea is a symbiosis, right? There are going to be steps that you can purely use AI for, or at least sub steps. Or like, say, idea generation might be an example where instead of, you can have AI spit out a pretty darn good list of special situations if you're looking at that, which would take you hundreds of hours, or maybe at least dozens of hours to find on your own. So, great use case, very quick. You don't mind the occasional errors and so forth. We can get into why. To places in the process where you want to combine your efforts with AI together. And finally, to places where I think, at least, right, you don't want to outsource. So I think you don't want to be using AI to be lazy or take shortcuts. I think you want to use AI to save time on less differentiated tasks, to then invest that time back into where you can add more value, more qualitative judgment, more kind of primary research, perhaps, whatever your process is. So I think we're at this really unique and exciting stage where no one really has a huge advantage over anyone. And the only way I think to lose is if you don't engage with it, and you either assume it's all hype or you assume that it's not for you. I've had like grizzled value investing veterans reach out to me, like give me good feedback on that paper, which, by the way, was the selfish reason for writing, is that, hey, I want people to write, I have exact prompts I use in my process all in there, and people are reaching out to me saying, oh, this is great. What about this? Or, hey, this might not work. Like, It's almost a collaborative kind of a public collaboration kind of aspect to it. There's nothing gated. Everything is, in the public arena. But I think if you don't use it, you're missing out on that learning curve of because your process should be different from my process because you're different than I am. So you need to figure out how to use it yourself. And the only way to do this is to roll up your sleeves and start actually applying.
So I'll mention for the benefit of this audience, Gary and I recorded a Talking Billions episode all about AI. It will air in January. Incredible conversation, an hour and a bit. But I want to ask you one little teaser from the conversation we had. So people look at AI as time savings. You make a point beyond that, and you say that certain analysis can be actually superior than human analysis.
Mm-hmm.
You asked the question, what wasn't explicitly said but was implied, for example. So you're kind of looking for what's missing. Can you talk about it briefly, how that work? Because it's something that I think people are not thinking about as much, the category 2, as you call it.
Yeah, so like I talk about category 1, which is doing what humans can do, but just faster or cheaper, versus category 2, which is doing something we couldn't do, even though we had more time or money. Yeah. So like the one case I found, and I wish I had another 10 to share, but those are hard, is, for an example, let's say you have access to a library of expert interviews, TIGAS, whatever, GLG, whatever you use, right? And let's say you can put it in with something called Notebook LM, which is Google's tool that uses their Gemini model, and you can have an interaction with that purely based on that knowledge of those expert interviews. And then you can ask it to find patterns that I think even if you read every single transcript, you or I as a human would probably not find. An example would be what was left unsaid. Like, what are the things that were implied by these experts about the management team or about the culture? And like the kind of the example I would give is when I was at Fidelity, they brought in former CIA interrogators to teach us how to conduct management interviews. And one of the things that stuck with me from that is that we were told, I think correctly, people don't lie by telling you the opposite of the truth. They don't, if you ask them, how old you are, they don't tell you like, 57 when they're 46. I think they answer a different question truthfully. Mm-hmm. So the example I think in our conversation that you referred to was, maybe you ask, hey, how good was the company's culture? Something like that. And maybe the person, the former employee you're talking to answers, I really enjoy going out for beers with the guys after work, right? And you might leave that conversation thinking, I answered the question. Yeah, that was a positive answer. It was, but it was a positive answer to a different question. So I found that AI, in a few cases, that is really good at picking up those kind of things and also finding common threads. And like, for instance, like I have a standard list in that AI equity analyst, I have these prompts, and one of them for this, and that, like, what I ask is, what are common areas of agreement and disagreement among the experts? So AI is so good in looking at text and parsing in the way that it says, they all agree that the CEO is a narcissist, but they love the fact that he has great, vision or whatever. I don't know. Yeah, I'm just making this up. But the point is, you might miss that as you're going through the details of each expert interview. Yeah. That stuff, I think, could be gold because it's so quick and it's just great.
I think it's fascinating. I love that you're sharing this work in public with the white paper. And I love seeing the conversations back and forth as people tweak this, because your prompts from 6 months ago will not be your prompts today. The models change, the LLMs change, the way you ask the questions, the way you understand the answers, it all evolves. And it's a really cool process that you have to feel this way, like get in the stream with the progress to let it carry you forward.
Yes. And I think, look, it may be like a final point on this. I remember back when I kind of made my process public, when I launched Silverring, I, said, anyone who wants to, here's my owner's manual where I'm very in depth about how I invest. And my mother, who always, I'm the only child, she always looks out for me no matter how old I get. She's like, why are you giving away all your secrets and blah, 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 blah. I'm like, these are not secrets. Buffett gives away all his secrets. How many Buffetts are there? People with Buffett-like returns. not to get into this tangent, but there are plenty of people claiming to try to clone Buffett. No one has succeeded so far as I know. The trick is in implementation. So I think that there's far less risk in seemingly being generous than trying to sit in this isolation in this ivory tower and try to come up with some proprietary way, then collaborating, putting your work out there and try to iterate faster and try to get to the right answers for you, or the better answers for you. In the meantime, helping other people get to the right answers for them. So I think that the differentiation is in terms of investing results over time will come from other things, not from the tools, but from temperament, your investment structure, a whole bunch of other things. It's not going to be because I have a clever, LLM prompt than you do.
One of our favorite closing questions: if there's one thing you could teach the average investor, what would you like to teach them?
Yeah, no, I think about this a lot because, when, coming back full circle, we came into this country, we were poor, my mom had to be on welfare for the first couple of months till she found her full-time job. So I think about the average investor a lot because as soon as she found that job, she, started putting money into mutual funds, for very few dollars of savings every month. And that's how I got interested in investing, because I'm like, what are these mutual fund things? But I mean, I would say, sadly, and this might not be exciting, is that the incentives in the industry on average are not in the favor of the customer. So if you're an average person and you have a couple $100,000 of savings, I would, strongly caution you against trying to buy things that are being sold to you, whatever the flavor is, whether it's private credit or, private equity for retail, whatever is being sold to you, and look for the incentives of the people selling to you. Like, how are they compensated? How are they motivated? And if you're unsure, and this is not financial advice, but my personal opinion, what I tell friends is there's nothing wrong with going to Vanguard and just staying in a broad, low-cost index fund, because if you can't understand something yourself, chances are someone else who is selling it to you, they're selling it to make money off of you, unfortunately.
A very silver ring lesson to come back and end if ever I did hear one. Gary, if people want to find out more, they want to read the Substack, they want to see the paper, where should they look you up on the internet?
Yeah, absolutely. So the Behavioral Value Investor Substack, is a great place. I'm on LinkedIn, happy to connect there. I'm pretty active. And then the paper, it's too big to post, but there's a link, I'm happy to give it to you guys so you can include it or communicate it. There are other ways if you just reach out to me. And you can just automatically download the AI Equity Analyst white paper on the AI. Take a look for yourself.
Fantastic. We're going to encourage everybody to do that. Bogomil, thanks for co-hosting with me. I'm Matt Ziegler. That's Gary Mishuris. Gary, thanks again so much for coming on Excess Returns. You're going to have to come back.
Thank you so much. Really appreciate your time, guys, and you having me on.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.